All right. Well, I think we should probably get started. We have a bunch of people that have joined. So good morning, everybody. Thank you for joining. I know these have been really uncertain times for a lot of people. And if you're an early stage founder, you may be sitting there wondering how on earth you can fundraise in this environment, or if you picked the worst time in history to start a company. And you know, there's a lot of different things being said. Some people are saying, oh, VCs are open for business, they're doing investments. Other people saying, no, they're not open. Some folks think the bar is higher, that valuations have changed. Other people are like, nope, business as usual. So today I'm excited to actually hear the facts and a genuine perspective from two of the most respected seed investors, Sacha Patel, who's a partner at Homebrew, and Aditya Agarwal, who's a partner at South Park Commons. Even though they don't need introductions, I'll do a brief introduction and then we'll get right into it. So for Satya, prior to starting Homebrew with his partner Hunter Walk, he was the VP of product at Twitter, building and leading product management and user services teams. Before Twitter, he was a partner at Battery Ventures, where he co-led the seed and early stage investing practices. Satya was also an early Google employee, where he joined in 2003 and was responsible for product management and partnerships for AdSense. So he's had a really unique and amazing combination of both experiences in venture and on the operating side. And we're excited to chat with him today. So welcome, Satya. Thank you for joining.
Happy to be here. That was very nice of you.
And Aditya Agarwal is a partner at South Park Commons. Before becoming an investor, Aditya was an early Facebook engineer. Rumor has it he was employee number 10. He can verify himself.
We'll take it.
Where he wrote the Facebook search engine, and he was also their first director of product engineering. When he left Facebook, he actually became a founder himself by starting Cove, a modern collaboration software company, which was acquired by Dropbox. And while at Dropbox, Aditya built and scaled the engineering team and became the company's CTO. Aditya and his wife Ruchi have reimagined what Silicon Valley should look like and how it should operate for very early stage founders with the creation of South Park Commons, which is not only an early stage venture fund, but also a vibrant community of passionate founders and technologists. So welcome, Aditya. Thank you both for being here.
Yeah. Super excited to be here. Thank you for having me.
Of course, of course. All right, so let's kick it off. So a lot of things have changed in the last couple of months. I mean, we really are truly in unprecedented times. And many VCs are sitting on a lot of dry powder. But you know, some people have different views on what they should do to invest in an environment where we have close to 30 million unemployed, and that's a scary thing. Would love to hear from both of you just what you've been seeing in terms of activity. Is top of funnel slowing down? Are funds like yourselves actively deploying or waiting and sitting this out? So maybe Sacha, we can start with you on just what you guys have seen over the last several months.
Sure. I'd say the mistake that people make is think of the VC market as a single market. It's really a number of sub-markets. You've kind of got the seed stage market, the kind of growth stage market, and then the later stage market. So I think of it as C, kind of Series A through C, and then Series C plus. And those three markets are reacting very differently to the existing environment, I'd say. On the kind of growth and later stages of the markets, those firms are dealing with a lot of trouble in their portfolios and doing portfolio triage, as they talk about it. It's very unclear how to value companies because there's a lot of uncertainty about the public markets. It hasn't yet trickled down to the private markets in a meaningful way, except that people expect that public market valuations are going to come down. So that's impacting valuations at the growth and later stages. And so all that uncertainty means that the Series A and later firms are reacting by taking a wait and see approach for the most part. There are partners at those firms that usually only do 1 or 2 investments a year. And so they usually aren't in a rush to make those decisions if they don't have to, right? There's no downside to not doing a deal right now. So with that less certainty, there's definitely a lot of sitting on the sidelines. The only exceptions are, rocket ships like Index is involved with, like Figma and Notion. But besides that, I think you're seeing a lot of those later stage firms pause. The seed side of the market is, I would say, completely different. We feel like it's really active and really has returned to levels that we were seeing pre-shelter in place. There were about 4 or 5 weeks where things slowed down quite a bit. But because the seed market is really investing in teams and products that are going to be in market, in 18 months and 12 months, and are really focused on building for the foreseeable future. Seed investors can't afford to wait to see if the market has turned around before they write a check. And also, unlike some of the later stage firms, seed firms only get one bite at the apple, right? They are usually seed focused. So if they don't write the check at the seed, they don't get to think about writing it at the A or the B or the C, which a lot of the later stage firms do. So we're seeing seed activity be effectively similar to what we saw, maybe marginally slower. And there's a slight decrease in valuation relative to pre-COVID, but there's only so much compression that the valuations can have at seed. So that's at a high level what we're seeing.
Got it. So that's good news for some early stage founders. Aditya, what are you guys seeing? Are you seeing folks leaving and starting companies and coming to South Park Commons? Or are you still seeing the same amount of activity?
Yeah, no, that's a great question. I'd say I thought I completely agree with all of Satya's points there, kind of the bifurcation of the markets and kind of like the activity within each of them. I think a few things I'd add are, if I look at least for us in South Park Commons, we were actually trying to be a little bit data oriented about this just a couple of weeks ago. And we're just trying to kind of analyze our kind of like our funnel, our investing pace and so on. And we have not actually changed our pace at all. Now, keep in mind that our model is a little bit different where, we're not trying to be exhaustive at the top of the funnel. We tend to be much more focused in the number of investments that we do compared to most early stage firms. And we like to take on concentrated positions. But certainly I think that, the part that really rings true based on what Satya said is that, I am not of the belief that this is a crisis that will last for, like decades into the future, right? Like it's very hard to time whether it's going to be, 6 months, 12 months, maybe even 18 months. But I think if you really are of the belief that, this is going to last for 2, 3, 4 years, then I think that leads to a certain worldview that you have to use to make your investment decisions. But if like most people, you think that, we'll have some new normal that isn't too bad within 18 to 24 months, in 18 to 24 months is kind of the time frame along which most seed bets that we are making will be having their first or maybe second shot on goal, their first iteration. So I tend to think of it as that like in terms of just like a macro view and of like the timeline in terms of how these companies work, I don't think it affects us. Mm-hmm. I'd say one kind of like caveat I would add to that is, even within the spectrum of all companies, I do think that we are seeing a somewhat, a fork in the road between, I would say, more pure software companies and kind of like companies that have like a little bit more of an atoms or kind of like an offline component, right? Because even if you look at the public markets today, I think what you're really seeing is continued strength by a lot of the pure software like businesses, right? And I think a lot of the reason for that is, the pandemic, it will lead to new long-term behaviors that I think are hard to predict today, but I think we can confidently say that it has massively accelerated trends that were already kind of like happening. And, to that end, like, kind of like the SaaSification of our entire kind of like essentially companies, or kind of the reliance on software as a key essentially building block, both for end user applications, but for how companies are run. I think that it has kind of massively accelerated that. If you look at, for instance, Satya has kind of like, had a good quote, I think, in the last Microsoft earnings call. If you look at Azure, GCP, and AWS, the quote that he used is that you kind of have seen 2 years worth of digitization in 2 months, right? And that really is kind of like acceleration. So I think that when I apply a lot of these trends to essentially the seed investing, but also I think across the 3 buckets that Satya said, I think the pure software companies are actually building on strength from strength, because a lot of the core thesis is actually going to come out of this pandemic looking even stronger. I think it's a little bit more variable for the companies that are much more, have an atoms or kind of an offline component.
Mm-hmm. Yeah, that makes a ton of sense. I love the analogy of accelerating, or it's almost like, the entire world fast forwarded into the future by like 50 years into like a fully digital world. And I think also like for SMBs, they really are going to look for software. Like even if you're a restaurant owner and you have no software to do like a simple thing like takeout, your phone's ringing off the hook, you have no way to predict demand. So I agree. I think actually, if anything, it's made technology be a mission critical thing for maybe some of the laggards in the economy. So that's great to hear that you guys are still seeing, great founders and are actively investing and actually maybe there's more opportunity based on this acceleration. Has the bar changed at all from like a risk tolerance perspective? Because, even though you guys are investing with a time frame of, 18 to 24 months, there's still so much at the top of funnel. Has your bar come up like higher in terms of risk tolerance, or are you still looking for the same things as you were looking, before this all started? Maybe Aditya, we can start with you on that.
Yeah, sure. I mean, listen, like I would like to tell you that we have an investment system that is like super precise and objective and kind of like, is almost, kind of is able to block out all of the macro noise, but that's not true, right? I think that anytime that the world is kind of going through a seismic shift, I do think it affects your thinking. But I like to think of it more as kind of like returning to the basics and kind of like exerting discipline, where sometimes that discipline can be harder to have if like the entire ecosystem is not kind of exercising that discipline. So I wouldn't say that I wouldn't say that the bar has gone up so much so as I think we're being more precise about how we both precise in the observations that we are looking for, and also being a little bit more, again, precise in how kind of the conclusions that we're drawing from those observations insofar as it leads to an investment, right? And I think across the board, everybody is doing that. Like, honestly, where you could be a little bit fast and loose, like, essentially, maybe call it a year ago, I don't think you can afford to be as essentially fast and loose as you were today. Now, assuming though, I mean, now discipline, like, once you factor in the discipline, I'm comfortable essentially like, having the same valuations and stuff like that, because again, my macro thesis is that the world, is going to come back to normal in 18 months. But I do think that the input variables have to be more precise. And I don't think the output variables need to change as long as the input variables we have high confidence on.
Got it. Sacha, what about you guys? What, like, in terms of valuation? So it'd be helpful maybe to share some numbers, like where are seed deals that are pre-product and pre-traction getting done today?
Yeah, like I said, I don't think there's been a dramatic change, and our most of our data comes from the Bay Area that we invest across the United States. So I'd say, seed deals that are pre-product, pre-traction are still getting done somewhere kind of 6 million to 10 million pre-money. Raising anywhere between $2 and $4 million. That seems to be the range that we're seeing. And I think Aditya made the right point there. Like, starting companies and investing in companies is just about evaluating a series of risks. And, nobody's taking more team risk than they were before. In fact, if anything, to the extent that it's possible, you're taking less team risk, right? Everyone's taking more market risk than they were before because there's just so much uncertainty about the market. And then finally, from a product standpoint, I think people in general are trying to take less product risk. And that either means that they want to see more product developed, or they want to have even more conviction around the product thesis. But in general, at the seed stage, most companies that start end up doing something a little bit differently, if not entirely differently than what they set out to do, right? So the one thing you have a hard time changing is the team. The net of all that is, I think the risk tolerance is effectively the same because, again, at the seed stage, we're investing so early and for a point in time so far down the road that we can't evaluate things too much based on the current environment.
What about check size? So we've seen a few seed funds, they used to do like $3 million seed rounds, and now they're like, oh, no, like we're just going to invest $1 million. Have you guys seen that at all? Or are you thinking about your deployment pace any differently than in the past?
No, we certainly aren't. I think like at SPC, we have been consistent from a pacing standpoint, from a valuation standpoint, from a check size standpoint. Our view is, your strategy dictates your fund size. And so once your fund size is set, you better stick with the strategy that you tied that to. And so it would be a mistake to try to adjust too much to what's going on in the market. Now, you may want to, write a smaller check to get the same ownership you did traditionally because you can get a lower valuation, as an example. Or you may say, hey, in this market, we want to do more pre-seeds than seed rounds. But I think those are all, kind of variations of the same strategic theme. There's no fundamental shifts that we're seeing in terms of how people are approaching it.
Got it.
Yeah, I mean, what I'd add is that, I think I've definitely seen a little bit of people trying to arbitrage kind of like basically macro fluctuations. But my personal take is that I cannot predict, how all of this stuff will look like in like 3 to 4 to 5 years. what, I instead will operate from a view that like essentially, the world, it's going to go back to normal. It's going to take a little bit of time, but, we actually have the buffer of time in seed investing. So my take is our check sizes have actually remained the same. I'd say that our strategy has actually remained exactly the same because like you just can't predict the world like, 2, 3, 4 years from now. And I think it'll look more similar to today than it was. So I don't think, we have not changed dramatically on that front, right? And I think that's actually the right thing to do by the entrepreneur, because anybody kind of representing that they are now giving you a low valuation because they have some, knowledge about the state of the world, further down the line, I think is probably kind of being inaccurate about their ability to do so.
Got it. Got it. Well, maybe we can, so it sounds like you guys have been very thoughtful about, what has changed and what hasn't changed. Clearly one thing that has changed is you can't meet founders in person, right? So would love to hear, and this is a question from Natalia over the chat, have you invested and would you invest without meeting a founder in person? And then the second thing is, if so, how do you conduct diligence and build that trust and rapport with somebody completely virtually? Maybe Sacha, we can start with you here.
Sure. If you're going to live up to what Aditya and I just said, which is not changing your pace in this environment, then you have to get comfortable with making investments in teams that you don't meet in person. And we've done that. We've closed 3 investments since sheltering in place. One of those was with a team we met entirely over Zoom. And just last Friday, we signed a term sheet with another investment with a team that we met entirely over Zoom. And so we've had to get comfortable with it. And the way we've approached it is you've got to spend more time with the team than you might when you're able to pick up different cues in person. And so we've done many more Zooms than maybe we'd like to do with the founding teams. And we found that it's actually easier to get time with people to do that because there's a lot less things that they're distracted by. So it hasn't meant that it's taken longer to get deals done necessarily. It just means we're spending more time getting to know those people. And the other thing that's given us comfort in the 4 deals that we've either closed or signed is that they're markets that we've had a prepared mind for a long time, right? I think it'd be a lot harder if it was a team we didn't know and a market we were trying to get smart on. But in those cases, there were teams we spent a lot of time with, teams that we were able to back channel reference very extensively, and markets where we had a prepared mind and had a set of hypotheses about their development to begin with. So we've been active, and amongst our seed brethren, we've seen similar behavior.
Yeah, I completely. I thought. We have not had any issues in making investments without meeting the founders. I think we've actually hit exactly the same pace. I think we've done 3 or 4, we have closed investments since SIP started. The reason I was smiling is because I think there tends to be a little bit of exceptionalism when it comes to thinking about how investors work. But ultimately, people are hiring employees and onboarding them, all remotely. People are selling software all remotely. Right? All of these things, I think that we are just another part of the ecosystem, in my opinion, right? And I think in order to get the whole ecosystem to function, I think we're also it's actually not that hard. And I think what we have done is that we've actually probably asked for a lot more data, right? Back and forth, maybe than we would otherwise, because instead of something that we could have asked in person, we're asking for more data requests and more written feedback, which has been quite valuable. And also doing more Zoom calls, which to Satya's point has been a lot easier to set up than going through the rigmarole of the in-person meetings and so on. But I have not found it an issue to essentially make these investments without meeting our folks in person.
But I think it's a mental shift that an investor has to make. They have to be committed to the idea that they're going to make investments this way. Otherwise, it's easy to use the excuse I'm never going to get to know this founding team really well and those kinds of things. And I think there are certainly investors who are still trying to figure out how to make those types of decisions. I think you just happen to have 2 here that have decided, to Aditya's point, if we're going to tell our companies to continue hiring, continue selling, and continue to do the things they do, we should probably operate the same way.
Yeah, totally. Maybe it would be great to just hear about one investment that you guys both have done over the past couple of months that either you had a prepared mind about for the market, or you felt the founder was super compelling, just so folks can get a sense of what deals are getting done and what kind of seed companies are getting funding from the 2 of you.
Yeah, sure. I can start. Both of these investments haven't been announced publicly by the company, so I'll keep it at a fairly high level. They're both, so one company is essentially around, they basically have a view of the world that we have seen a massive explosion of essentially the amount of data that is both generated and then kind of like analyzed in order to run all kinds of business processes, make things more efficient and so on. But the interesting thing is that this massive kind of like Cambrian explosion of data, kind of like, multiple orders of magnitude, has all essentially been quantitative, right? It's all kind of like numbers-based data. So what if you could really bring that same mindset to a lot of qualitative data that is kind of like essentially being generated out there? Kind of fits into our thesis completely that, data is changing how a lot of these companies are built or operated to make them more efficient. So we just thought this was a huge market in terms of tapping into a data source that for some reason, pick whatever, your favorite tool is, right? Like, Redshift, BigQuery, all of these just deal with numbers. They don't actually deal with qualitative data. So that was one investment. And the other one is kind of more in the, we are of the belief that, statistical methods, also known as deep learning, will basically change again, like the way that essentially a lot of this data is analyzed at scale. And we think that this will kind of fundamentally change how, again, like a lot of these companies are run. I think machine learning, deep learning is all tag words, but ultimately a lot of it is about like analyzing massive amounts of data in an automated way. So we have kind of like made another investment in that particular front, actually, with Index. That this last one that I spoke. So it was kind of working with Mike Volpe on that. So that's been good. Yeah.
In terms of the investments that we've made, again, none of them have been announced, so I'll talk about them from a category perspective. We made one investment based on the idea that kind of culture and community within organizations will be even more important than it has been going forward. And so it's a SaaS platform that helps drive employee engagement and kind of reinforcement of company culture. We made another investment, which is using machine learning models to help improve software quality based on automated testing and various other things. And then third, we do a lot of, fintech investing. And so we made an investment in a fintech B2B infrastructure company that's helping deal with a very specific problem that all fintech companies are facing around flow of funds and the delay of sending money from one point to another, given the rails and infrastructure that exists today. So as you can see, kind of wide from a category standpoint, but very consistent with, per my earlier comment, the categories that we've historically invested in terms of SaaS and marketplaces and financial services, et cetera. So not trying to kind of do something that feels awkward or uncomfortable in today's market, but very focused on, killer teams with a unique insight, addressing opportunities that are hopefully going to be large markets over the course of time.
Mm-hmm. Are there any new themes? A lot of people now are like, oh, like remote work is everything, or like video as a platform, or, everything being contactless payments. Are there any new emerging themes that you guys are excited about that you think, will be here to stay long-term, even post-COVID?
Yeah, I can start there. I mean, I think it's hard to know exactly for sure, what will remain post-COVID, but I personally have been like pretty interested. I've been pretty interested to see if kind of like all of the time that we are spending at home, honestly, on our screens as well, is going to result in kind of like new and different kinds of like consumer experiences. I think that the market has been pretty kind of like essentially devoid of any new innovation on kind of the consumer part of the world for a while. Kind of like, Facebook, Twitter, all the big social media giants kind of have really taken out the oxygen from the room in terms of like grassroots innovation. I wouldn't say I'm seeing a ton there, but I am curious to see if there is kind of like more activity there. And I guess that the other one would be, I think it's a little bit of what Satya said, which is, in a similar sense, can you bring more of like the consumer, essentially like fun, light, kind of like mindset to the workplace, right? Like if we are going to be doing a lot of remote work, how do you kind of like infuse it with some of essentially like the entertaining fun part of like those tools that I think we see a lot more in consumer, and we've seen a little bit more, I would say, with like the Slacks of the world and all of these modern collaboration tools, but I'm curious to see how much further it can be pushed to actually make it more fun to work remotely.
Got it. Makes a ton of sense. I mean, I think from our perspective, we're really excited, continue to be excited of, the future of work, which is something that we've been investing in for a really long time. Also really excited about empowering businesses that used to rely only on, in-person interactions. I mean, if you think about even like healthcare, like telemedicine was just like beginning, and now kind of the green light has really shown that things that are more convenient to do online, I think are going to stay for good. Things that are more social that people do for fun, I think the world will return to normal. I do think there will be kind of a verticalization of Zoom, right? Where Zoom becomes like a GCP or AWS platform, and then there's software specific applications built on top that enable you to do things like education. Like I'm sure teachers have a terrible time on Zoom with like 30 small squares and people raising their hands and making sure no one's cheating and things like that. So I think it'll be really interesting to see the innovation cycle given the more like consumer demand for convenience on some of these things. So we're excited about that. So we have a bunch of questions, and I'm sorry, I won't be able to get to them all, but I'll try my best to bucket them. So
but can I ask Nina, I would love to get Satya's take on the new stuff that he's seeing, or new sectors that he's seeing, if you don't mind.
Yeah, of course.
Yeah. I think what, at the end of the day, like if we were really smart, we'd start companies, right? So we are kind of led into innovation by founders. But what we're trying to think about is like the same kind of types of opportunities that you mentioned, like restaurants kind of doing more takeout and delivery, people doing more telehealth. What are the second and third order effects of that? So if people are doing more telehealth, like how do you get access to your past medical records so that you actually have the information you need to figure out, who you should be talking to, when, and give them the information they need to do a proper diagnosis. If you're a restaurant doing more takeout and delivery, how do you then deal with a very different flow of inventory management and then hence also ordering and supply chain, right? So what are those second and third order effects of kind of the core things and changes in behavior that we're seeing either with consumers or in the enterprise? And so those are the types of things we're trying to figure out. But again, at the end of the day, we're going to be led into innovation by smart founders who are living and breathing these problems. But I think the kind of obvious trends around kind of more e-commerce, more collaboration, more telehealth are all going to feed into that thinking. It's going to be in the water in some way with the entrepreneurial community for the foreseeable future.
Definitely. So let's shift gears a little bit. There's a bunch of questions about how you're managing your portfolio and also thinking about when you raise your next fund. So let's start with this question here of how you're supporting the founders of your portfolio companies during this time, and what are your top 2 words of advice for them?
Go ahead, Aditya.
Sure. I think at a high level, we are actually taking a much more active approach with all of our portfolio companies. I think it was a little bit, and we generally tend to do a good job with that, but we have kind of taken this opportunity during COVID to really like button that down, kind of like have a regular cadence of like check-ins. This seed companies often, you don't want to impose, one of the advantages of being a seed company is that you don't have to have a ton of process or structure, right? You can kind of like go with the flow and kind of like really like, focus on the actual problem that you're trying to solve. But I do think that, so we try to essentially be part of that. But as part of this whole COVID thing, we've tried to be a little bit more hands-on in offering our help, right? Which is like, hey, we're here. These are the different ways that we can help. Whether it be as simple as like, a weekly check-in to just for the founder, for someone to talk to like actually kind of going in and, rolling up our sleeves and helping out with like concrete problems that they might be having. So we are kind of offering our time and assistance, which is, something that we like to do at SPC. I'd say that the 2 words that, if I had to pick 2 words that we're counseling our founders on would be patience. And also like, I don't have a concrete word for this, but like be really clear if you're in offense mode or defense mode right now. And there are plenty of opportunities to be, there are plenty of cases to be made for a bunch of our companies to like, don't just get sucked into the macro kind of like gloom and doom. You need to be playing offense right now. And for some companies, it's like, no, you have to play defense, right? Like play defense until you have a clearer idea of what the world looks like 3 months from now. So, but being crisp about that, don't waffle is kind of what we're telling people. Yeah.
Does defense mean just cutting burn and extending runway?
Just basically like, tread water for a little bit, just see how like, the macro might affect you in 2 or 3 months. Again, often for those companies that are not pure software is the ones that we are kind of advocating for that. Yeah.
Sacha, what about you guys?
Yeah, I mean, for us, we're similar in that when we make an investment, we're generally taking a board seat, and then we actually have a standing biweekly or a weekly call with the founding team. So that hasn't changed in terms of kind of our operational model. I mean, genuinely kind of where we started was focus on the health and wellness of your team. And as you can imagine, as we were talking, I think before we started, there's a lot of complications for people who have elder parents that they're taking care of at home, or young kids that they're taking care of, or aren't in a large enough apartment where they and their partner can both be on Zoom at the same time. Like there's all kinds of things that come up, right? So focus on the health and wellness of your team, and do what you need to do to maintain and reinforce the culture of your company as everyone's working remotely. And then the second thing I'd say is kind of time is on your side, right? So to Aditya's point, figure out in an environment where customer behavior is unclear, whether it's a consumer or an enterprise, sales cycles are probably much longer than you anticipate. What are the things that you can focus on to de-risk the business and give yourself enough time where maybe we're the odd investor who's saying like, don't necessarily focus on revenue, right? That's not going to be what you're measured on a year from now by investors, because every market and every company is going to have gone through a period where things are slower. So, but what are the things you're going to be able to point to and say that these are the areas in which we've reduced real risk about the business, so that the next dollar feels like they're taking less risk than the earlier dollar. So that's kind of the conversation we're having with every company to be clear on what are the objectives over the next 18 to 24 months.
Got it. And there's a really good question here from Sam Warren at Horsley Bridge, who are LPs in a lot of venture funds. And his question is, has your view changed on reserve ratios? Like, are you reserving more to kind of bridge some companies through, let's say, this time period? And then second, when you think about your next fundraise, are you thinking about raising less or more, or how do you think about, the amount of dollars that you'll have to deploy over the next couple of years?
Yeah, I mean, as Sam knows, because Horsley is one of the longest, institutional LPs that's been investing in the asset class, including in us, that there are a lot of levers for GPs to pull to think about managing the fund, right? You can change your check size, you can change the number of investments you make, you can change your reserves, like all these things, like one decision impacts all the rest. And so what we've been trying to do is stay consistent with our approach in terms of how we're thinking about dollars and companies, et cetera. But maybe be forced to make some hard decisions around, which companies really deserve support, or which companies do we want to double down on, or those kinds of things. So I think there's not yet enough data. We're still crazily enough only a couple of months into this thing to know, is there a fundamental shift that we have to make based on what's happening to the portfolio and to the broader market? We're making contingency plans, but our view is to hold firm in terms of the approach that we're taking. And similarly, in terms of the next fund, we raised our latest fund at the end of 2018, and the plan was to raise the next fund in 2022. And that remains the plan, because again, we haven't changed our pacing or the check size or any of those things. So we try to be consistent. Just like we're trying to be consistent during a bull market, we're trying to be consistent during a bear market.
Yeah, I mean, I basically echo Satya's points there completely. I think that, for me, I think of raising the next fund, the fund size, kind of the timing of that. Those are output variables for me. The inputs really are kind of like the strategy that you want to use to be able to kind of like essentially find great investments and grow them, right? Like, what is your preferred like ownership size? Like, how many investments are you going to make? What role do you want to play? And given that we haven't really changed the input variables, I think that the output variables actually for us remain about the same. Our investment pacing is the same. We're still following the same strategy. So I do think that, not much has changed on that front. Now, again, I think much like we are telling our companies like, hey, you really should understand the different levers that you have at your disposal, such that if the world goes through another like huge dislocation quickly, then you need to understand the levers that affect your business, right? We also are taking, we want to make sure that we understand the levers really well, so that if we have to make some changes that we can, but we haven't seen, those levels haven't changed for us. So kind of the output variables remain the same. Yeah.
Got it. So I know we have a bunch of international founders joining us on the call, and there's been a lot of questions about, with the shift in remote working and being able to do an investment completely virtually, has this expanded your geographical scope for, searching for investment opportunities at all?
This is a good question, because if you wanted to be completely, semantically accurate about this, then one would say that it doesn't matter if the person on the other end of the Zoom is sitting in San Francisco or in India. But I think making the investment is kind of like one part of the overall journey in helping a company, right? I think a great kind of investor is able to really bring their knowledge of a particular domain, which one could argue is kind of location independent, but also has location dependence to it. Their kind of connectivity into a particular like ecosystem, and also like, their time, right, which is often can be a function of like geographic like proximity. Our fund in particular focuses, most of our investments are from the Bay Area. We do some kind of like, in places like Utah, we do some on the East Coast. We've made a few Indian investments, but the vast majority are in the Bay Area. And the main reasons are simply because Ruchi and I have like the best connectivity here. We also have connectivity in India, but I think more or less like the better way to put it is that we feel that it is much harder for us to actively support companies that, are geographically pretty remote from us. So I think we'd be doing them a disservice by essentially taking on those investments, right? Like the capital is just step zero. And then there are a lot of like follow-on things that you have to help with, which I think are harder remote. Yeah.
Yeah, I think that's exactly right. We've been US and Canada focused investors from the beginning, and it's strictly because we think those are the areas, the geographies in which we can actually be helpful. If we were the investor of choice for a company in Paris or in Istanbul, that company would be making a mistake, because there's better suited investors for them. And so we try to remain focused, despite the fact that we're making investments over Zoom. The people on the other end are still in the US or Canada.
Right.
Okay, this is an interesting question and a bit of a tough one. So Aditya, you referenced how, it's been a little bit difficult to invest in the consumer space because we haven't seen like a big platform shift like we had, offline to online, desktop to mobile, social, et cetera, et cetera. And, we haven't really seen a lot of that in the last couple of years. But now that so many consumers are at home, do you think there's and maybe like, behaviors have changed permanently in terms of convenience or how they consume things like media. Do you think there's a bigger opportunity to actually build companies that go against like the Googles, the Facebooks, the Netflix, the Amazons? Because in the past, we've seen a lot of acquisitions, right? As soon as companies get good, they get acquired by some of the big tech players. And I just wonder if there is a consumer shift that then makes it a little bit easier for new ways for consumers to interact with technology or, have different expectations. Just curious if you'd be bullish on that space.
Yeah, I mean, I think it's, having worked at Facebook pretty early on, I think one of the things that's often hard to say is that, you don't go into building Facebook thinking you're building the next Facebook, right? You're just kind of like building something cool that hopefully a bunch of people love to use, that like, a bunch of people actually find joy, right? And so I think, when somebody comes and kind of like tells me they're going to be the next Facebook, I'm like, yo, we didn't know it was going to be Facebook either, right? So I think the more dangerous part of the last 5 years is that, so I think that the only thing you can do in the social consumer space is take a shot on goal, right? Like actually take a good shot on goal. And then I think there are a ton of variables, some which you can predetermine and some which you can't, that lead to kind of like those massive outside successes. I think the more dangerous part of the last, not dangerous, I think the more like sad reality of the last 5 or 6 years is that people aren't even taking those shots on goal, right? Like there's kind of like been a general kind of like desire to be like, stay away for the reasons that you mentioned, Nina, right? But I think that this is kind of speaking from experience. Even the last couple of months, we at the fund have definitely been a bunch more open in terms of like, yeah, we'll take a look at like, some of these early kind of like stage shots on goal that, maybe a year ago we would have been like, no, this doesn't feel as though like it's possible to really get to the level of like momentum that you need. But I think we certainly are trying to be consistent here and be like, no, we'll actually take a look, right? Because it could be that some of these consumers or user behavior changes might be able to lead to the opportunity to build something. Yeah.
Got it. So let me ask you a tough question here. Would you, if like a startup came to pitch
Satya, you just asked me the other tough question.
So Sacha, if a startup founder came to pitch you and they have like an idea for travel or like restaurant software, like, would you invest in this time, or would you say, look, like the macro environment is a little challenging for these opportunities right now? Or maybe it's the answer that you said, which is like the time horizon doesn't matter, but just curious, like, are founders that are working on those ideas completely doomed?
I don't think they're doomed, but I think they better have a brilliant insight for why the market, when it returns, is going to be hungry for what what they're building and selling, because when it does return, it's going to take time, and the dollars are going to be allocated to the highest urgency, highest impact things, right? Mm-hmm. So because we're focused on markets, again, that are 18, 24, 30 months out, travel will return in some form. And of course, people will start going to restaurants again in some form. Mm-hmm. So, but if we're going to invest in something in those categories right now, somebody's going to have to lead us on a mental journey around how that market's going to develop and why what they're building is going to be a must-have, addressing a hair on fire problem at that moment in time. And I would say that's frankly going to take a lot more convincing than a market that we have a prepared mind for and believe already is going to be important over the course of the next couple of years.
Yeah, interesting. Here's another great question from the audience. So how should companies think about building culture? Especially when more and more companies are announcing permanent work from home. And culture is so important, especially in young companies, and iterating quickly, building a cohesive vision and unit. Have any of your companies done a good job of this? Or even for you and the firms that you work at, how have you guys kept the culture positive and together during this tough time?
Yeah, it's been, I'll speak about South Park Commons, the community, right? I'd say that it's been really interesting, right? Because again, we have the South Park Commons Fund, but the community, kind of like has 40 to 50 members. And it's an interesting time to kind of be a community that really is, even the name is kind of centered around a physical location, right? Like the idea is that it kind of gives you a physical and, kind of like mental space to go in and essentially tinker and explore with like-minded people. But one of the things that I find really interesting is how, we have spent a lot of time trying to recreate like the more honestly, like unstructured moments of interaction. Like, for instance, what is the version of the 3 p.m. tea time that we do every day, mm-hmm. right? Like, how can we get to know more about each other? For instance, we have daily, I guess you can call them photo challenges, right? Like post like, the most disgusting thing in your fridge, post like, your prom photo, post like your last Halloween. So basically ways of essentially learning. I feel as though like what makes a great culture is getting a more well-rounded idea of like who you're working with in your team. Because ultimately, right, like you need to show up not just for the work that you're doing, but to be part of the team. And the only way to really do that is the way you build that camaraderie is to have a more holistic understanding of who that person is, right? To kind of really build that empathy and that sense of like common, essentially like, common vision. So we focused a lot on those things. And I think if I think about if I were kind of like starting a company right now, the questions I would be asking myself really are, yeah, I got Slack, I have Zoom, I have all of these new things that allow me to be productive, remotely. That's great. How do I actually make sure that people are also still kind of like having fun, connecting at a level that is not just about productivity? And I don't think that the tools, they're not, cut and paste tools for this. So I think you have to actually be pretty creative. So, we're seeing a bunch of our founders do that, but I don't think that there's a simple formula for that yet. I think people are having to be pretty creative, but it's pretty cool to see the output of that. Yeah.
Yeah, I echo a lot of what Aditya said. I think it starts with just being intentional about your culture and values to begin with. I think a lot of companies make the mistake of not articulating what those are early on. So I think that's super important. Secondly, is realizing that even more than when everyone's together in the same office, when you're remote, kind of repeating the culture and values, over communicating them, and living them is more important than ever. And living them really ties to the third point, which is what Aditya was talking about. There's living them professionally, right? And so companies are doing, like, making sure they're doing the all hands and citing, like, when there's something the company does or something an individual does, which is consistent with the culture and values, all those kinds of things. But then there are the things that are not professional, right? Like, everyone knows, like, a big part of being in the office is not just like you're productive all the time. There's lots of unproductive moments that are productive in different ways. So we've seen people do, Zoom trivia. We use with our founders a product called Icebreaker, which, like, sets you up automatically in a room with one person for 3 minutes and then switches to another person with specific prompts for things to talk about. We've had companies who are doing, like, if people are old enough to remember MTV Cribs. And so, like, one person each day, walks you around their house. We've had people, we came up with the idea, which some of our companies liked, which was the people who have young kids at home, like, bring them into a Zoom and one day have them pitch everybody the business. Like, how would they describe the company that their mom or dad works at? So there's lots of things to do to kind of create those fun, unproductive moments that are really what's missing from everybody being in the office. But that has to be paired with, like, the professional reinforcement of the culture and values in systematic ways through written, verbal, video communications, and through the actions of people on the team.
Yeah, the one we are doing today is to basically, everybody has to post, like, a photo of themselves when they were 3 years old.
Right.
Nice.
Yeah.
Do you have yours? Are you going to screen share?
Yeah,
right
I'm gonna, can I screen share?
now? Do it.
All right, let's see if I can share screen. Boom, let's do it. That's me right there.
That attitude.
That's the only way to do it. Oh, man. Okay.
That's awesome. That's awesome. One of the things that's been interesting is I actually hired an associate, this amazing guy named Abdul, to join us, and his start date was like middle of April. So I had to figure out how to onboard him completely remotely. And it was actually fun to get really creative. So we did a tribute video. Have you guys seen this website?
Oh, yeah, sure.
So you just make, like, a quick video. So we had everybody in the firm, we have offices in London, SF, and Geneva. We had everybody welcome him and say one fun fact. Poor guy had to watch like 18 minutes of video because our team is so big. But he got to, like, put a face to a name. And then I assigned him, like, a buddy. So he had somebody that he could do, like, a Zoom call with every day, and then spent a lot of time, in Notion putting together an onboarding doc. But I think that there'll be some really interesting opportunities that pop up, especially as folks hire more remotely in general, to do things like culture and onboarding. So it's really cool. Awesome. So we have about 10 minutes left and we have like 28 questions. So I'm going to blitz through some of these. Okay. So this question comes from Finn at SPC, and it kind of ties into a question I have as well. So, many people talk about how some of the best companies, the best technology companies, were really all started, in the middle of a financial crisis, like Airbnb, Stripe, and Uber. Do you believe that this crisis will result in a similar wave of companies? And, do you think it's a good time to start a company right now?
I would say that there's truth to what people are saying, but people are also conflating kind of the fact that there was an economic downturn with there being some fundamental platform shifts, right? So in the 01 to 03 timeframe, kind of bandwidth, high bandwidth internet connectivity and commerce were really kind of taking hold for the first time, and happened to coincide with the dot-com bust. And similarly, in the 07, 09 timeframe, you had the emergence of mobile as a killer platform for development. So it's hard to attribute kind of the success of some of those companies entirely to the fact that they were created during a downturn. There's no doubt, because it happens all the time, that incredible companies will be created now. I think the question is like, what are the technological shifts or the trends that are going to support those companies coming out of a more difficult environment? And I don't know what those are going to be. It's hard to identify kind of what those key platform or technological changes are. But that's our job, to be on the lookout for those and to identify founders who are living in and see the future. But I wouldn't necessarily say that it's entirely because we're in a dire economic period that great companies will be created.
Yeah, I mean, what I'd add to that is like, I think it's hard for me at least to kind of know exactly, like Satya said, that, was 2001 or what's 2000 and whatever 8 or 9 kind of the best time to start a company. I think the way my macro view on the world is intrinsically that technology is going to kind of like, basically fundamentally reshape a ton of industries. I think there are way more opportunities out there that continue to remain out there than we have essentially like companies in the world. And I think right now is as good a time as any actually to start a company, right? In some ways, a lot even better, because you can kind of like get a level of talent aggregation that I think is very hard to do in like a super kind of much more frothy market, if you will. But I think for those people, like, I would not let the macro situation, if you have something you're passionate about, you think you have a unique point of view, a unique take on an idea that you're really passionate about spending a bunch of time to kind of solve, I think you shouldn't let the macro situation right now dissuade you. Because I honestly don't think, I think it's like, I think as a founder, I do tell people that it's, it's important to time stuff right in terms of catching the wave, but at the same time, right, like you can't always time the way the whole world is going to be turning. So if you're really passionate about doing something, I think right now is like as fine a time as it was like 2 or 3 months ago. Like, I don't think that much has changed.
Yeah. Also, I would add, the fact is like a lot of VCs have raised a ton of dry powder over the last couple of years, right? Like VC funds have raised record amount of fund size. And I would say like from an index perspective, actually, we are actively looking for Series A's, and we're not saying like, oh, it's too risky to invest now, or I'm going to wait to see, when this is up. And I'd say like for us, not the criteria hasn't changed, but I think you have to make a compelling case for, why you can get through this time. For example, there was a lot of companies that were like doing great, and then COVID hit and their revenue literally went to zero. Like think about a lot of companies that process payments, right? I think for us, we take a longer term view, because when we make these investments, we're looking at like 5 to 7 years out. And so for us, it's important to make sure like the team has domain expertise, you have a compelling case for why you can be strong when this comes back. And so I think it's still, even if you start a company and you can raise a seed round right now, and this goes on for a long period of time, I think there's still opportunity to raise, Series A rounds, as I know there's a lot of questions about that. Okay, just to wrap up in the last couple of minutes that we have, you guys see incredible founders day in and day out, and better than anyone based on your experiences just how hard it is to even get started building a company. I mean, you really have to have a clear vision, and even that vision might change over time. So, to all the founders that have tuned in listening, what are the top 3 words of wisdom you'd give to an early stage founder looking to raise a seed round from either one of you in the coming months? Maybe Satya, we can start with you.
Sure. Listen, I think, we've talked about kind of we're still active in the market and we're still looking at opportunities and all those kinds of things. But I would certainly say it's still true that if you don't have to raise money in this environment, don't do it. Because especially if you're in a business or a vertical that's been hit hard by COVID, or in a business that won't be able to demonstrate real progress for the next, few months or quarters, like you're going to be better off bootstrapping, raising friends and family money, like doing whatever you need to do to kind of prove out a little bit more. So that would be my first thing. If you don't have to, like, don't do it. The second thing is, if you do have to, or you do feel like you want to fundraise, just remember that you're not fundraising on an absolute basis. You're fundraising on a relative basis, right? Like we and every investor is looking at lots of companies. And so it's not just like, are you building a great company? It's, are you building a company that is better than every other company we might have the opportunity to invest in? And so it's always a high bar, but I think investors are even asking themselves that question more often, right? Is like, is this the one company, or this, or in our case, are these one of the 8 companies we want to invest in this year? And so you always have to remember that you're raising money on a relative basis, not on an absolute basis. And then the last thing is particularly true in this environment, but always true, like, what is the one exceptional thing that the investor is going to leave the pitch with that sticks out about what you are doing or who you are, right? You've got to identify and emphasize that one exceptional thing that's going to help you stick out. So it could be the people on your team, it could be the potential of the market opportunity, but the reality is at the seed stage, you don't have proof of anything, right? And so you're going to have to convince somebody to make an irrational decision, right? Investing in seed, I argue, is always an emotional decision more than a rational one. And so you've got to make that investor believe in something exceptional about what you are doing or who you are. And absent that, you will struggle to raise money in this environment. So those are probably the 3 things I would point out.
Yeah, I mean, I think Satya said it really well. I think what I would add is that I'd say that if you're looking, to kind of raise money from South Park Commons right now, I think I think you should be pretty precise and kind of like intellectually rigorous in kind of like, kind of how you are thinking about a particular product or a market, right? I think that it would be hard to kind of raise money, like kind of based on a set of assumptions that don't feel as though they've been well thought through, right? Like, you could afford to be a little bit fast and loose, I think, a year ago. I think right now what we would be looking for is just like more precision and kind of like more rigor in like kind of the thinking around a particular, like, a domain or a problem set. And the other way of kind of stating it is that, you kind of want to have a pretty, not necessarily unique, but a pretty strong view of like where the world is going, and to be able to make a pretty compelling case for that, right? And I will echo what Satya said, which is that, it's easy to look at a fundraising deck and kind of like check all the boxes, and, that's kind of interesting, but not really. I think that the big thing that I'm looking for is like, what are 1 or 2 things that this product or this team or this, their point of view that is truly could be 10x better than what we have right now, right? On it should be like 10x on some dimension that I can see. It's kind of the way I'm thinking of it. Yeah.
That's great advice. That's, yeah, I think that's very helpful for all the founders. And I would echo a lot of those same qualities still persist for Series A. There's no like bar, like you have to be at 1 million ARR or anything like that. But, you have to be a crystal clear communicator. If it was hard pitching in person, like pitching over video is harder. You lose some of the magic, right? So you just need to really articulate what you're doing, and explain why you've either experienced and have domain expertise or have built them quickly. And then I think being really intellectually honest about the market size and why now is really important too. But anyways, I know we're out of time. Satya and Aditya, thank you so much. This was an awesome conversation. And thank you to all the listeners for the great questions. We really appreciate it. Hope everybody stays safe. And, if you're looking for seed funding, you have 2 investors right here that are actively writing checks, and a Series A investor here too. So awesome. All right, guys.
Thank you all. Thank you.
Thanks for joining.